Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing show. I'm Victor McClure.
And I'm Guy Allard. I'm just wondering if a combined 60 years is better than a singular 30. And if the 60 years is two 30s that run over the same time frame, does it really count as 60?
Yes, why not?
All right, let's go with that then.
We had another compliment came from Leslie. It comes almost every week. They liked our voices together, how they work together. I go, we've known each other like 30 years, so I guess.
That's right. Then we have a face for radio, a voice for print.
Speak for yourself.
Yeah, the old joke.
Well, thank goodness the elections are over.
Amen.
Oh, if I see another commercial, my son, he's 15, almost 16 now. He goes, well, what do you believe? Because one of them makes him look like a saint, and the next one makes him look like the devil, and they're like right apart. I go, you just got to kind of weigh the good and the bad kind of thing, and note it, and, tell yourself all politicians are liars.
The funny thing is, the market, for the most part, has things priced in 6 to 9 months down the road. It's pretty fast responding. They expected the Democrats to win the House, and they did. And that day, the very next day, the market goes up 550 points. But if you dig a little deeper and unpack it, it's funny. The market investors love gridlock in as much as, there's not going to be any spending policies and there's not going to be any real big changes, and it's kind of a status quo thing, which is why it likes it so much. When one party has everything and they can get things done, there's a little bit more uncertainty for the market.
What they say, what's that? Is it the doctors, physicians do no harm, something like that?
Oh, the
hypocritical oath or something like that.
Hippocratic, isn't it?
I don't know.
I don't think it's hypocritical.
Well, I think they think since they can't do anything, they probably can't do any harm.
That's right, and that's why the market likes it so much. And
I know.
But we'll see. It'll be an interesting few years. Hopefully, they'll play nicely and they'll be able to get along and do some good things.
Oh, yeah. I mean, in the old days when they negotiated, you're in power, you get like 80, 90% of what you want. Now pretty much it's 100% or zero, and they can't agree on anything.
And they say a good deal hurts both parties a little bit, right?
Right. A little bit of pain on each side.
A little bit of pain on each side.
Every negotiation I've ever done with buying businesses, divorce, or whatever, it seemed like it was all pain.
You felt like you had all the pain.
Pretty much felt like all pain. I don't remember any nice fuzzy feelings or, hey, I'm getting something out of this deal.
No.
Seemed like I just got screwed every time.
Oh, no.
But I'm sure that's the way I'm looking at it from my point of view.
But hopefully, if nothing else, if we can't get a lot of things done, I just hope the drama goes away. That'd make me happy. How about you?
Yeah, that's not going to happen.
That's not going to happen, is
it?
No.
It used to be, like I said, I've got a lot of relatives are Democrats, a lot of relatives are Republicans and all that. And they used to, have a decent debate or talk about it and joke. Oh, my gosh, not anymore.
No.
It seemed like I can't even be in the same room with you. I'm like, you've been relatives for 50 years. I'm sure you can be in the same room. No, I can't stand them.
I know.
So... it's just, who knows? But I'm glad it's over.
Market volatility continues. Earlier this week on Thursday, the Fed decided not to raise rates, which was anticipated, kind of figured in the market. Market's also anticipating a rate hike in December. It's yet to be seen whether we'll get that or not.
I'm torn on it. I'm always torn on rate hikes.
Where do you want to see them go, ultimately? What would you think?
I mean, they're still not normal. You know? I kind of like the old days when at least you're never going to have the 1980 days where you had 19, 20% CD.
And we don't want that.
No, because trust me, even though you're getting a great savings rate, you're losing money to inflation. Prices are going up faster than that, so it's not good.
That's right. You should see what 2.5% inflation does to a portfolio on one of our plans. You don't want us to run it with 8 or 9.
It gets really ugly really quick.
Yeah.
But back to normal, like 5-year CD paying 5%. The reason I'm using CDs instead of treasury bonds and 10-year deals because people relate to that more.
Give me a 10-year number. We're at about 3, give or take, 0.1% now.
Maybe 5 or 6% on a 10-year. But I don't know if it'll ever get there.
I don't know if it will either.
It started hitting there like 2007, I believe. It started creeping up from 2002.
Right.
And then all of a sudden they beat the Fed funds rate down like 15 times in a row. So they'll let it go. They'll raise it. But if it starts causing the economy any jitters, they will kill that thing. Because they don't care about savers. Remember that. Everybody thinks the government cares about savers.
You know,
they do not care about
they
savers.
want growth.
They want people to spend money.
Yep, and growth.
How do you spend money? Well, when interest rates are low, mortgages are better, right?
Yep.
Business loans are better.
Yep.
Credit card debt, well, that's always stinky. That always stinks regardless of what interest rates are.
No, they don't.
Oh, we're down to 1% Fed funds rate, 25%.
21.99. It's funny though. You just talking about a 5% 10-year, which is probably a decent number. Made me kind of cringe a little bit. Rates have been so low for so long, and we're at 0. When you say 5, I'm just like, oh wow, that's high. But for 10 years, it's really
but even like
not.
A normal yield curve.
Yeah.
Where 1 year is 1%, 2 year 2. I mean, I'm talking
right.
about. Making.
Yep.
But just do that. So okay, a guy that wants to go out 20 years, he's going to get 7-8%. Now you got a flat to no yield curve where a short rate and a long rate are pretty close. So why am I going really long? Why would I do that? If I can get within 1% or something shorter, I wouldn't. So that's why it kills those long ones, and people don't like. That's why they eliminated the 30-year treasuries years ago, but they brought them back.
And we talk about this many times. I was going through a portfolio for a fella. Decent sized portfolio, and I guess about $12 million or so. And part of his portfolio was in a variable annuity, say about $1 million. Just rough numbers. And half of that was in bonds. And I was like, oh well, that's good. He's getting safe. And then I looked and I saw the words high yield. Oh no, which Victor and I talk about all the time. That's the replacement. That's the candy-coated version of a junk bond. If it's a high-yield bond, they have to give you a high yield because they're not creditworthy, or they wouldn't give you a high yield. They'd give you the normal rate.
Why would a company get a loan for 7% when they can get one for 3%?
Yeah,
because they have bad credit.
But people do that now, chasing the return.
That's right. And so when interest rates are going down, high yield aren't bad. Remember, because people can refinance out of the debt and make for lower payments, even if they get in trouble. When interest rates are going up like they are now, what's the ones that get hurt the worst? The lower quality ones. In other words, high yield is anything below BBB. If you're below BBB, you're called non-investment grade, junk bonds, high yield bonds, whatever you want to call them. Then above it is called investment grade bonds.
And that's a preface on the statement. It said non-investment grade high yield bonds, and then that 53% didn't look so good. It's like, oh no.
Remember, the longer maturity, the worse it goes down if interest rates go up, and the lower quality. So if you had a AAA bond that was going to go, it had a 1 year term on it.
Right.
I don't care what interest rates are going to do; there's not going to move much.
No.
But if you had a 20-year bond AAA, it's going to move a lot. If you have a junk bond, BBB under BBB, and it's long, that is what moves the worst down. And by the way, what do you think is in most high yield bond funds? They're long and they're low quality. That's how they got the yield so high.
Chasing the yield.
That's right. So anything that says how you got to stay away, I don't care if your broker says it's the greatest thing. Look, it's averaged 7%, 8% for the last 20 years. I don't care. It's still going to go down, and you're not going to make anywhere close to that anymore.
And we're in a rising interest rate environment.
This is the one time you do not look at past performance. You cannot look at past performance in a rising interest rate environment, because think about it. Yields were going down for like 30 years. 30 years since the early 80s. That's what interest rates were doing. So anytime you look at the past history of a bond fund, and it went down 30, it was gone up for 30 years plus the yield on the bonds,
That's
right?
That's right.
You're going to say, wow, I'm going to do this bond fund. That Victor and Guy said that bond funds are crap, but this thing's averaged 8% a year on a bond.
They don't know what they're talking about.
They obviously don't know what they're talking about.
It's a combined 60 years experience thing.
Yeah, 60 years of nothing's what it is. But that's what you've got. People don't understand. They always look. It's okay with equities.
Yeah.
I want to look at a longer term thing. I'm going to say, how'd they do in 08? How'd they do 2000 to 2002? Means zero, zada, nilch, zip, when you're talking about a bond fund in a rising interest rate environment.
And if you've got bond funds and you're not quite sure and you want a third opinion, we do it all the time. We certainly don't do any arm twisting. We're happy. We get statements emailed to us every day to kind of go through and audit. Call us 972-715 2424. Be happy to go through that for you.
715-2424.
Absolutely.
All right. Our website's ilovemyretirement.com. Okay. Let's talk about a little something that I always think fondly of, divorce. I'm only kidding, by the way. There's a new.
Anyway, go ahead.
A new court
You're
ruling
talking about a puppy or something.
from the 8th Appeals Court, 8th Circuit.
Right.
I always try to remember which ones are conservative, which ones are liberal.
And they certainly have their own.
Right.
Ninth Circuit.
And there's also a Supreme Court ruling that throws a little monkey wrench in some things. Some of the things that we know about financial planning, retirement planning, are kind of put on their heads a little bit.
Are you saying they're legislating from the bench?
No, of course not.
Okay.
Of course not. They would never do that.
They're not supposed to do that.
But we'll talk about that because these court rulings do affect your 401ks and your IRAs.
If you're going through a divorce
And or bankruptcy. And we'll talk about that when we return. Remember, if you have any financial questions, you'd like to take advantage of our no-cost, no-obligation retirement plan, stress test, Social Security Optimizer, call us at 972-715-2424 or go to ilovemyretirement.com. I'm Victor McClure. You're listening to I can't talk today. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
All right, well, here's a fact instead of a sales pitch.
Lay it on us.
I got to change those bumpers. I think I put them out like 20 years ago.
Yeah, they still work. Well, you can start talking about divorce.
That's right.
And your IRAs,
There's
inherited IRAs.
A bankruptcy court ruling, one of the appeals, 8th Circuit Appeals, Bankruptcy Appeals Court. What happened was, husband and wife got divorced, and the husband was ordered to get half of the wife's 401k. And what he did, and then once he got that, he declared bankruptcy shortly after. Now, typically in bankruptcy, 401ks are exempt. In other words, you could have $1 million in a 401k and it's exempt. Now there's an unlimited amount of 401k.
What's the limit? That's 1.3?
1.3 if it's an IRA. Right. So if you roll it to an IRA, it's 1.3 million that is exempt from bankruptcy. But what they ruled was, nope, if it was part of divorce, if it's ever changed names, in other words, that 401k is now, or that IRA was in someone else's name, regardless if it was a divorce proceeding or not, it does not have those same protections anymore.
Or inherited then, apparently, too.
Inherited IRAs as well, which affects a lot of people.
Absolutely.
Because typically a 401k is the most judgment-proof thing in the world, most protected thing in the world. If it's your 401k, bankruptcy, creditor, anything, they can't touch it, right? But if it goes to an IRA, they can't touch the first 1.3 million. All of that is gone if it is not in the original owner's name.
Now, this is going to depend a little bit, right, based on state by state, based on some appeals.
That's right.
What district you're in.
That's right. Some states have it different, but that's telling you that's
the can of worms has been opened.
That's right.
It's already open, or Pandora's box, or however you want to phrase it.
Usually the one thing good about Texas, well, I thought so too, the elections, that we're pretty conservative with stuff like that. The reason is because we had unlimited amounts on everything.
Yes.
Like even non-qualified, like annuities.
Yep.
There were non-qualified retirement accounts, not a 401k or an IRA.
Just an annuity.
Non-qualified.
Yep.
It is 100% judgment proof in the state of Texas, which is great, right?
Other states have dollar limits.
That's right. But it's still not going to be bankruptcy proof. So that's the difference here. So you still have judgment proof stuff. I've always said assume.
Or nursing home proof. A lot of people sell them that way, and the nursing home can get, if you've got a bunch of money in annuity, they'll get it.
Right. So that's what you always remember. Annuities, IRAs, 401ks, I always use the simple rule. They're all judgment proof if you live in Texas, unlimited, unless there's two things they can change at. Divorce, right, or the IRS. If the IRS wants you, they're going to get you. They can take whatever they want.
Anytime.
That's right. And divorce can reach across any of those judgment proof, creditor proof things. But it's just an added thing is you got that a 401k that was in someone's name or an IRA is now not creditor proof. Or for bankruptcy purposes. We're not talking about somebody sues you and wants to get it. If they sue you, they still can't touch retirement accounts. Now, annuities, IRAs, 401ks, or annuities inside of those are very judgment proof. Be sure you take advantage that if somebody sues you or whatever, they should never be able to touch that stuff.
I don't know if you can be very judgment proof. It's like either you're pregnant or you're not, right? Either is can you be very judgment proof?
Right. They can always change the law. That's the only thing, right?
No, I'm just giving
I always know that divorce and the IRS get everything. Now, the next thing also, this is a good one. All the contribution limits for your IRAs, your 401ks, your
Good
SEPs
stuff.
are all increasing for 2019.
Good stuff.
Everything is increasing, so the amount you can defer from your paycheck will increase. The amount your company can match will increase. So all the totals will increase. We'll kind of go over them. All right, 401k.
Are you going to increase our matching?
No, of course not.
Damn it.
The 18.5 is your 401k deferral. Okay? In other words, you can take out, what's that, $1,500 a month?
This
whatever.
year.
That's right. Next year's $19,000 a year. So you can divide that by 12 months.
Very nice.
All right. Now,
And if I'm over 50?
no, there's 6,000. 6,000 remains the same. So the total last year was 23.5 for over 50. Now it's 24. No, it's 25 now. I'm sorry. It was 24.5 to 25. All right. Defined contribution plan, you put in 56,000. It was from 55. Defined pension benefit used to only take the first 220. Now it's 225. In the max compensation, you can consider for defined benefit plans is 280,000 from 275.
Got it.
Most people don't care about this stuff.
Nope.
A lot of it. The one they will care about is a 401k.
The last one on that
That's
list there is no fun.
Taxable wage base.
It's gone up again. They're taxing FICA and everything's getting more.
Don't you remember when we? Gosh, I remember looking at my Social Security statement. It used to be the first 40 grand was I think it was $40,000 what you had to pay Social Security on.
That's right.
Then it started moving up. Well, it's 132.9 now.
I know. Up from 120 something?
Yeah, 128.7.
You're right.
But I think it was just like 3 or 4 years ago. It was 112. I mean, it's pretty soon. It's going to be you're going to pay Social Security forever, and you're not going to make it. We already make it when you make over like 90,000 a year. You get like $1 in benefit for every $5 you put in. It's heavily weighted towards, people of lower income, and I'm okay with that. But that's what always makes me mad when people say you don't pay your fair share, and you do.
Well, and you get
it's
a
still
lot
a good deal.
You get a lot back for your benefit.
That's right. So all of these different ones. Now remember, your SEP limit's gone up and everything. Every kind of IRA limits. SEP is simplified employee pension. When you would need something like a SEP would be, let's say me and my wife have a business. We don't have any employees. We may have some 1099 people. We don't have employees. Well, you can put like 25% of your compensation into that thing up to like $57,000 directly off your income tax. So those are good. The reason why they're saying that, it's better than the $6,000 you can put in an IRA or whatever.
And the problem, if you have a lot of employees, is whatever you pay yourself, if you're going to pay yourself the max 25% of your income, you can't pay the employees 10% of their income.
That's gonna be
you
25.
have to give them 25 as well.
After the break, we got one coming up. I'll explain different ones for small business owners that might be better than a SEP. Don't hesitate to call us if you have any questions. 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome to the Common Sense Investing Show. Right before the break, we're talking about retirement plan limits going up in 2019. Since, boy, this time flies. It's only a month and a half, and it's 2019 already.
We're there. Holidays are here.
Oh, yeah. But you can put more in your 401ks. Remember, 19,000. If you're over 50, you can put another 6,000. So you can get $25,000. Last year it was like 25.5. Also, remember your IRA contributions. IRA $6,000 with a $1,000 catch up if you're over 50. Why do people need to look at these other like SEP and all that? Because if you're 50 years old and you just started savings, $6 or $7 grand a year ain't gonna get you there.
Not going to make it.
All right, so you need to have another one. The first one was a SEP IRA, Simplified Employee Pension IRA. It allows you to put up like $56,000 or whatever. But if you have employees, you don't want to do that because you put in 25% of your paycheck. You got to put in 25% of all the employees. If you have a small amount of employees, then you would do probably a simple IRA. Simple, you can do $13,000 in deferrals instead of $19,000 with a 401k, right? And you got to catch up of $3,000, so you can put in $16,000 if you're over 50. And the reason why you're looking at a simple is because 6 or 7 isn't enough on a regular IRA.
It's twice the amount.
That's right. So simple IRA does that.
So the catch-up provisions have remained the same. The 401k, the 403b, 457s is 6. It's been 6. It's still 6. The simple that Victor just talked about is 3,000. It's been 3,000 for quite a while.
Is 3,000.
Yeah, we're talking about the catch-up, and the IRA is still 1,000.
Right. Simple's, if you're a small business owner, let's say you've got 5 employees, 10 employees, you just got a choice. You can either match up to 3% contributions. So in other words, you're putting in you can put in, if you want to put in the max, let's say the owner, you got to at least match up to 3, or just give them 2, regardless if somebody wants to contribute to their plan or not. Just give them 2. That's called a safe harbor provision.
I've known of an employer that actually lowered their payroll by 3% so that he could make the match of 3%.
Oh,
what do you think of someone who would do that?
Oh, it's terrible.
That is terrible.
So remember that. That is why you can get more deferred. You'll do a 401k. Now, if you have more than 9 employees, just look at the 401k. But usually 401k, if you want to make safe harbor, you got to just put 2% to everybody's account. Why would somebody do that? Well, because usually the owners are older, or the directors, managers are older, and they want to put in their maximum. Because if you have a 401k, there's something called top-heavy testing. If your younger employees aren't contributing a similar percentage to your older ones, they will make you just give you the money and then they pay tax on it. You won't let it go in a 401k because your company is considered top-heavy. But if you just did a safe harbor provision, remember, match up to 3 or give 2, they'll become a safe harbor 401k. Or safe harbor simple IRA or SEP IRA. So safe harbor is not a SEP, it'd be a simple. But a safe harbor will allow you to.
I don't know about our listeners, but I'm fairly confused at this point.
All we're trying to do is talk about if you're a small business owner or self-employed.
Absolutely.
Do the other plans except an IRA, because you're not going to, $6 to $7 grand a year is not going to get you there. If you have any questions about that, call us. We'll tell you, all right, how many employees do you have? How many are 1099? How many are W-2? We can kind of direct you in the right direction to which plan might be the best for you. It's 972-715-2424. Again, 972-715-2424. All right.
Do you want to go into the health savings accounts, or?
I don't think enough people have them, but
and they didn't increase it much. It was $3,450 last year contribution limit, and it's $3,500 now. So it's like a $50 increase for an individual. Family went from $6,900 in the health savings account to $7,000. They also have catch-up provisions of $1,000, and then they get into the out-of-pockets and maximum expenses. Probably not as important. So they've increased how much you can contribute into your health savings account for 2019, but not much. $50 more for an individual, and basically $100 more for a family, and the catch-up is the same.
So don't forget, call all your 401k providers in January, because you can increase the amount. Your January paycheck, you can increase the amount you're deferring or electing to defer in your 401ks. Some people don't, a lot of people, they're just putting in 4% because they can afford it, right? But if you're one of the type that maxes out, which is very smart,
absolutely,
if you can afford it, max it out, meaning you're going to have to add another $400 a month to your contribution, whatever that is, or $200 every 2 weeks, whatever, so you can get up to the max for 2019. All right. There was a study done, the independent study, not an advisor. They weren't present or anything else. They're just calling people. And they asked them, what are the 5 or 10 things, they said 5 things you'd expect to hear or want to hear from a financial advisor when they're talking to you about retirement. What are the 5 things most important to the individuals? We're guilty of this like anybody else. We try to tell you what's the most important thing in retirement. Well, this is the study's opposite. It's going to say, all right, what do clients perceive as the most important 5 questions you ask? And we're going to go over those after the break. Remember, if you have any financial questions or like to take advantage of any of our services, it's 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. Before the break, we were talking about this study that came out that asked, hundreds of clients or potential clients.
Investors.
Yes, it wasn't financial advisors call them. It was just a survey done. And remember, we tell you what's the most things of important in retirement, like our bucket strategy, having enough emergency funds, getting fixed income. In other words, a safe part of your money, earn more.
Make sure you're allocated based on your age, all the good stuff.
So that's what we've done for 30 years each. But this is a different study. That's what the clients want. Okay? The reason I'm going over this is, if you're getting this from your current advisor, that's good. If you're not, you might want to look up somebody else, because this is what people want, according to this study. First, number one thing that people want when talking about retirement planning or whatever would be, speak to me plainly. That's what we try to do, always. In other words, we'll tell you, do you like it when an advisor starts, reciting the Greek alphabet to you? Oh my gosh, look at this standard deviation of this fund here. Can you believe that? Look at the beta, the gamma. Oh, the alpha. Oh, it's blowing my mind.
Trying to impress you with their knowledge base isn't always
That's right.
the way to go.
Let's be honest, they probably just memorized that stuff, don't know really how it works anyway. Let's be honest there.
Stop them midstream and ask them, what exactly is that?
All of those Greek letters are measures of return or volatility versus some kind of benchmark, right? Depending on the benchmark and what it is, how much does it go beyond this and that?
It's funny, the article, and it was written to advisors as well to help us so that we make sure that we're speaking plainly. One of the suggestions it had was when you have these meetings to have an intern or a younger broker advisor in the meeting kind of audit you. So, if you slip into the sequence of return risk, some fancy nomenclature, that they'll stop you and say, what exactly is that again? So you can catch yourself. I thought that was a pretty interesting idea.
I mean, I'm guilty of this myself. I don't, like I said, recite the Greek letters. But my problem is I'm thinking ahead, and I'll go too fast with somebody going over a retirement plan or whatever. That's why my whole start of every meeting is, I understand sometimes I talk fast. I am a Texan. I'm from Texas, but I do talk fast, which is unusual apparently. But just slow me down. If there's anything you want. The problem is people are either embarrassed or they don't want, they're not the people that'll just interrupt somebody in the middle of a conversation. But it's really important that you do that, because once you get lost, they're keeping going, right? They're at 45 minutes into this meeting.
Yeah, you're way down the road.
Right.
It's funny, too, because, we really want the clients to understand everything that's going in, and some will have been self-traders, right? They've done their own stocks, so they've got a little better knowledge base. And I'll catch myself going into, no, your money's in long-term bonds. Each year those bonds throw off 3% interest. That 3% interest buys a call option so that you can be in the market, but you're not at risk. The market goes up, you exercise the option. The market goes down, it expires worthless. Not to worry, but next year it throws off another. You're like knee-deep in the weeds. Oh, no. Their eyes glaze over. You got to stop and go back.
When you have it, when it happens. As soon as you see it, you know what has just happened.
Yeah.
You just went right over their heads and great.
It's like trying to feed someone some water out of a fire hose. It's like, you just can't drink it.
So that's the main thing we try to do, is speak very plainly. Yep. We also talk this radio show. Now, I don't speak to it as plainly as they told us when we first got on the radio 20-something years ago. They told us 20-something years ago that we something just crashed in the background. We're just trying to figure out what it was.
Yeah.
That speak to like the audience like there's in 6th grade or something like that. It was 4th grade or 6th grade. I'm like, I don't even speak like that. I don't think there's any way I possibly do. So we try to do that with clients and everybody else. But remember, your advisor needs to speak plainly.
And if they don't, ask them. You stop and
just
ask
say, hey,
them.
slow down for a second. I didn't get that last one.
You do this every day. I get that.
Oh, yeah.
But tell me slowly.
Well, it's like the software and the stuff. We've looked over this thing 1,000 times.
Yeah.
It's the first time they're seeing it. So these want to do the 5 things that people requested. But not talking to an advisor, just talking about to a third party. When you're talking about retirement planning or something like that, what are the 5 most important things? Number 1 was speak to me plainly.
Something that's not even mentioned in there that, we fight with ourselves. Even when you and I are on the telephone,
right.
How often, talking to the listeners now, are you talking with somebody on the phone, and just as they're about ready to say something, you talk over them?
No.
It's like, oh, no, I'm sorry. What were you going to say? Right. And that's another deal, because you want to go through things and got to be careful not to talk over people.
Right. The number 2 things that the study showed is, remember, this is what people want from a financial planner, retirement planner, is tell me, don't sell me.
Oh, yeah.
In other words, tell them if there's any problems with their portfolio or potential problems, but don't slay on thick the sales pitch. Don't pressure them into anything. And it's one thing I'm very pride ourselves on doing. I don't pressure ever.
We
I don't believe in it.
We never sign paperwork with clients the first time they come in.
No.
I can't think of a time.
They need to have hours of studying this stuff before they do it. That's just what you should do.
And you don't know the questions that you really want to ask until you go home.
Right.
You got to go home and think about it. Then, I should have asked this. Well, next time we can.
Reminds me of bad experiences buying a car. Oh, this is only good for this 5 minutes, really?
Oh, that's right. If you don't buy it now, the deal's gone.
My manager said this is okay, and I imagine them in the back room laughing. Get him to sign this one right here.
That's right.
It's only good for today. I'm like, yeah, if it's only good for today, I don't want it.
I'm not interested. Absolutely not.
So you got to lay off of the sales pitch. To me, that's why I like math. I said the math never lies. We're just showing you your numbers and how they can be improved. That's not a sales pitch. That's just numbers, and then you go decide if this path is worth it for you. If you agree with my assumptions or disagree.
That's one of the greatest things about our jobs is laying. You find out that you get to know your client, you find out what they're trying to do, and just presenting them with options.
That's right, and that's what we try to do. So the first one was speak to me plainly. Next one is tell me, don't sell me, because so many people get on the hardcore sales pitch. Oh my gosh, here's all the benefits. They forget the negatives. They're not letting them think about it like they should.
And no matter what you need, their one product is the solution for no matter what your circumstances.
That's right. Every single thing in the world. This will work. That's right.
That's right.
And that goes for stock-only people, annuity-only people,
mutual fund
life
only
insurance
people.
only people, mutual fund-only people. People don't realize a lot of these companies are really mutual funds. All right. Stay with us, folks. We've got a break coming up. If you have any financial questions, don't hesitate to call us at 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. This is our last segment, but it's not our last show.
It's going to be a good one. That's right.
We're talking about a study that was by just an independent study to people,
investors,
what they wanted to hear, the 5 biggest things they want to hear from a financial advisor, retirement planner.
How they want to be treated,
right.
What they want to hear.
Number 1 is speak to me plainly. Forget the Greek letters and all that kind of stuff, right?
That's right.
We try to talk about sequence of returns risk. We'll try to break it down into easier things to digest. Next one is tell me, don't sell me. The number 3 thing they wanted was talk to me about longevity. There's 2 things. Some people have a lot of longevity in their family, and they're already thinking this way. Oh, my gosh, my mom's 96 already, still alive, so I really think longevity. What's harder for us to convince is people that their parents, like both my parents died at 71 and 70 or something.
Right, early.
So people I'm in the business, so I do believe in longevity regardless of what your parents did, but it is real difficult. They're like, nope, I only need about 10 years worth of money. I go, what if you live at 11? What are you going to do then? Oh, no, there's just no way. My family, I've already had cancer. Well, I get that.
Obviously, the genes are an indicator, but it's not an absolute.
That's right.
And things are
changing.
It
accounts for a certain percentage, but it's not everything. I mean, when a couple reaches 65, there's like a 75% chance one of them gets to 92.
Well, and the longer you live, Rob,
right.
the odds go up.
And you got to remember, like when you're doing Social Security, we hear this all the time. We've had for the last 30 years. I'm taking it at 62 because it took me to 72 to break even anyway.
That's right.
Nobody lives in my family past 75. And I get that, but they forgot cost of living adjustments, right? But they also forgot that if one of them dies, they're only going to keep the higher Social Security. So if you started both at 62, the only one you're going to keep is this little one.
That's right.
Right? So stretching that out, doing proper Social Security planning is very important because even if you don't have longevity in either you or your spouse, one of you can still get to 95 and you plan for 85 or something.
And when you want to retire and you're ready, you retire. But it's a joke, but I do say it tongue in cheek. Many a truth is said in jest. Your single best retirement asset is your job. So the longer you can work, as long as you like your job and it doesn't stress you out and make you sick or ill, working is a good thing.
Now remember, don't ignore women typically live longer than men.
Oh, yeah.
I like that old joke. Why do women live longer than men? Why do men die before women? That's because they want to. Finally
I'm not
laughing.
I'm not laughing with you on that one.
But you remember, and that's what I try. Like when I'm looking at doing Social Security planning, whatever, I'm like, okay, here's your optimized stuff mathematically. But now we got to think of, okay, does your wife have a lot of longevity in her family? Is she younger than you? Then it really makes sense to keep it going, to do it later. You don't know how many people, even they're making $300,000 a year, will take Social Security at 66 or whatever, because they're not penalized anymore, right? But they just lock their spouse into that level when they die, instead of locking them into a higher number when they didn't need that income for the 4 years anyway.
And there's all sorts of variables. We know that every circumstance is different. Sometimes some of you guys have wives that are 20 years younger. It takes a different tact for that because the Social Security and even fixed annuities, it takes a different tact. Some of you are on your second marriage and you started your second marriage later in life. Maybe it's 70, so you both have your own assets and you can do kind of things singly perhaps because you have different heirs and different. So there's all sorts of things that we take into consideration when we run these numbers.
Part of our job is putting together assets, splitting up assets,
allocations.
A lot of people don't realize, let's say you were married for 20 years to a spouse, that you can take part of their Social Security. It has nothing to do with them. That's what your ex-spouse will get, the exact same amount they're always going to get.
You're not hurting them.
But you can apply. Let's say you were a homemaker the whole time. You can still apply for half theirs even though you were divorced for 10 years, 15 years. A lot of people don't understand that or realize that.
That's a little nugget right there.
That's right. So those are the kind of things we talk about with longevity. It's not just how do we make the assets last. How do we optimize those assets, right? How do we make sure Social Security is a bigger number going forward and staying with the final spouse? How long should we plan to live? Now, living to 150, I probably wouldn't go. But living to 100, it kind of makes sense. So what happens if you plan for 100 and died at 92? It doesn't matter. You just left a little more to your heirs. That's okay. You got to plan for a worse situation, not a good or ideal situation. All right, the conversation number 4. Help me get a handle on income. This is one thing we really specialize in. Income. You got to know how much income is coming in. How much is guaranteed, how much is, I see it all the time. No, my dividend income is going to be this, and that's what I'm going to count on until I die. They can eliminate a dividend overnight.
Dividends are awesome, but it's not a guaranteed retirement.
No, there's nothing wrong with having dividends coming in.
Absolutely.
It just can't be the main component of your income producing asset. Remember, your Social Security is going to be there. If the pension is going to be there, any annuity income is going to be there. CD income can count. Bond income can count, but not things like dividend income. Okay? Or even I hear a lot on the preferred stock stuff.
That's right.
You can kind of do like a 50% on those because there's some risk there, but not all of it. And the last thing asked is discuss health care. Even if you don't know everything about health care, it says discuss health care. That's the 5 things people want. They want you to speak plainly. They want you to tell, don't sell. They want you to talk about longevity. Then if I can get back to my page here, they want to get a handle on income, on what are all the different things for income. And the last thing is health care. We just talked about this to a few clients this week. There's a difference between a Medicare Advantage plan and a Medicare Supplement plan. The Advantage plan usually has no premium to none, but it's an HMO. I've done this a long time. I'd rather pay the extra for a supplemental policy, not be an HMO.
That's what I tell my clients.
That's right. So call us if you have any questions, 972-715-2424. Again, 972-715-2424. I want to thank everybody for listening today. Remember, you can always go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allard, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.